Kumar Karwa joins us. Let's take our conversation forward. Let's understand what he makes of the mid-air turbulence, what we saw earlier this month, and are we in for a grand close for this year? KK, fantastic to have you back. Thank you for joining us. We saw a bit of a mid-air turbulence. It's like when you're in a plane and when you see a turbulence, you just get worried. And before we realize the turbulence get over. Have we seen that similar kind of a factor at play? Because just when everybody thought that markets have topped out, it's back on track.
The fundamentals of our market are very, very strong, and what we saw in the last 2-3 weeks was a very severe FPI selling, and that is more driven by global concerns than anything connected to the local markets. And yes, we saw a massive correction in our markets. But going forward, I believe that, as you said, that mid-air turbulence, but finally we'll reach our destination. So I'm sure that our markets, the fundamentals being what they are, valuations did get corrected, and now again we should be resuming our rally going forward. But having said that, my sense is that the return expectations that investors should be kind of muted. We should not expect a repeat of what we have seen in the last few years. So time to stay invested, and I'm sure over a medium term perspective we should be able to make decent returns.
On flows for 2022, the general concern which is now centered around high inflation and reversal of interest rates and outflows from India, is that a very valid and a reasonable concern for the first half of 2022, where we may start using word outflows rather than inflows? How do you see things moving on the liquidity front for next couple of months?
See, I think in the short term, yes, liquidity does impact valuations, and it is very natural to expect that with tapering, etc., and interest rates hardening overseas, that you will see some outflows from the all emerging markets. But within that, maybe India could be an outlier, because the growth that India offers and the opportunity to invest across sectors that India possibly offers. So my sense is that it's early days to assume carte blanche that there will be outflows. But also, having said that, I think you should look at the robustness of the domestic flows into the market. I think every month the domestic mutual funds were able to garner more than 10,000 crores plus kind of flows into the equity markets. And even the retail investors, direct investors also seem to be strong. So even if there is some outflows from the FPIs, I think the robustness of the domestic flows should keep the market in good stead.
Which in a sense has really blown everyone away, and I'm talking about blown away with the kind of response and the re-rating in valuations and stocks. That's the EV theme, whether it is a company like Tata Motors, or a re-rating in a battery company like Amara Raja, or a re-rating in a very boring utility stock like Tata Power. Is EV as a theme here to stay? Do you think if one buys into that entire supply chain, whether it is a car company or a supply chain company or a battery company, they will make money in 2022?
See, I think there are two ways to look at it. I mean, EV is there to stay, there is no doubt about it. Now, whether the listed players which are available in the ecosystem, who will be able to benefit out of it and who will possibly get disrupted, or maybe valuations could get disrupted, that is a question of time. But as investors, yes, you need to be cognizant of the threat that EV brings to the traditional players, and you should be prepared to expect valuations de-rating in some of the companies which possibly will be bearing the first brunt of the EV disruption. But yes, you need to find niche plays in the ecosystem which could possibly benefit. And I think whoever has been able to raise good amount of equity to invest in their EV plays, I think they should possibly do well.
Good morning. The last time you were on this channel, you had told Nikunj that one of the tricks to make money in a bull market like this is to stay invested and when to know when to take cash off the table. My simple question to you also is just the way we've been seeing the selling of the FIs, etc., and the uncertainty that had crept in. Is this the time to take money off the table, and is that something you folks have been doing?
See, on an aggregate basis, you need to be fully invested into the market. I think what we are alluding to earlier also and even now is that there will be sub-segments of the market or some sectors or some stocks in the ecosystem which possibly are overvalued. And when I say overvalued, in the sense that possibly the markets are discounting FY25, FY26 kind of earnings. Those kind of stocks, obviously, we need to be taking money off the table. I think to get taken in by the FPI selling, I think the reasons that they sell are probably far too different than what domestic investors look at. Domestic investors possibly are more bottom-up kind of investors versus FPI, which is more kind of various markets that they invest in, and they have other concerns that they look at. Case in point, I think what we saw in the massive selling that happened in the 2-3 weeks ago, many of the banking stocks where they are heavily invested, the valuations became very attractive and there was no reason for them to be sold off. And what we saw was again now a decent pickup happening in some of the banking stocks. So to answer your question, I think every investor needs to look at his risk appetite and stay invested. As far as individual stocks are concerned, I think it's more about have they run up far ahead of the curve. And we have already seen some of these sectors, maybe specialty chemicals, agrochemicals, where we have seen a decent amount of corrections having taken place owing to the overvaluation that some of these stocks had reached.
So we discussed that more, and we've been asking a big guest also what they're buying, selling, and holding, and we will do that with you as well. But first up on banking, and just taking forward the conversation that you were having with Nikunj as well. Where do you stand in the private sector financials versus public sector financials? We've seen the PSU bank stock try to play catch up, and there are many who believe that maybe they could even end up outperforming the private financials, at least in the near term.
So if you look at banks, obviously there are a few large private banks where valuations are attractive and they are growing ahead of the industry. And they will continue to do well on the markets. But the challenge with them is that they are reasonably over-owned. So maybe the stock price movements may not be reflective of the inherent earnings potential that these banks reflect. As far as public sector banks are concerned, there is some of the top 2-3 banks, they are adequately capitalized. They are showing signs of also showing credit growth at par with the industry. I think, and there is a reasonable amount of under ownership which is there. So as you rightly said, there is a distinct possibility that the top 2-3 public sector banks may outperform in terms of the stock market performance from a 12 to 18 month perspective going forward. Apart from the banks, obviously there are a whole bunch of NBFCs and specifically the housing finance companies which are enjoying massive tailwinds both in terms of disbursements as well as in terms of cost of money, and they should continue to do well.
Right. KK, a lot obviously depends on an investor's risk appetite, but do you think there is merit in classification via market caps, or do you think one should be invested all across because you don't know in the markets ahead, in the times to come, whether there is going to be a fair case of large caps versus mid caps versus small caps, or all of them are going to equally perform well or not?
I think, see, if your return expectations are very muted, or maybe, then obviously you need to be invested in large caps. But nowadays there are mutual fund offerings where you leave it to the fund manager to decide in terms of where to invest based on the earnings potential and the growth prospects, etc. Those kind of funds, I think they are called multi-cap funds or flex cap funds kind of. Those are the options which investors should enjoy, should invest in where they are unclear in terms of which market cap to invest in. But otherwise, for aggressive investors, I think from a next 3 to 5 year perspective, it is the small and the mid cap segment which will offer the maximum returns. We have a standard rule of thumb that if you are expecting say 12-15% returns from the large caps, then your mid market should at least give you 30 to 40% higher returns, and the small cap should give you double that. So if you are expecting a 15% kind of returns from large caps, then small cap should at least give you 30 to 35%. So if investors feel that their small cap portfolio will not give that kind of returns, then obviously it's a time to relook at that small cap portfolio.
Sure. KK, we've been asking all of our experts, where is it that one should buy, sell and hold in this market, given that one is now analyzing how the year gone by was and what should be the strategy going forward. You've already discussed a couple of sectors, but for the benefit of our retail audiences there, let's refresh your buy, sell and hold list.
For me to put fresh money into the market, I would imagine that the financials and the real estate chain, right from real estate companies to housing finance companies to all the ancillaries who supply to real estate. So that whole segment should do well. And obviously the third segment, which I believe from the next 2-3 year perspective will do very well, will be the cap goods and the infrastructure sector, where I think we are getting into a very strong capex cycle, which should help many of the companies in that sector to do well. So that's the whole segment that I believe should do well. In terms of avoid, my sense is that the consumer companies, they will possibly struggle on growth, and valuations being also rich, probably they may not add to portfolio returns, maybe from 12 to 18th month perspective. A dark horse could be, my sense is that where there are two schools of thoughts, my sense is that your passenger vehicles and commercial vehicles, that's a segment that should also be part of your portfolio from the next 2 year perspective.
So look at Polycorp, some of these capital goods stocks are making a comeback. So it's a good market. We saw that mid-air turbulence and it's back on the track when it comes to the market positioning and the market momentum. Tata group of stocks are also making a comeback. Hotel stocks are making a comeback. Media selectively is doing rather okay. So it's not a bad market at all. KK, the big trend defining moment for 2021 in a sense was listing of internet companies, Zomato, Policybazaar, Paytm, and all of them have happened in a bunched up manner very, very quickly. What is that big trend for 2022? Which you would say is a new trend or a differentiating trend?
I don't think so. First of all, that this internet-driven companies, that trend has ended. I think possibly that trend will continue going forward also. There are a whole bunch of new businesses which are getting lifted as we speak and which are ready to come to the market in the next 12 to 18 months. So I think this trend is going to continue, and investors will get a whole bunch of new businesses to invest in. I think the bigger trend that I believe has happened is that the maturity of the markets has become very strong. So we had a large IPO not doing well on the market, but that did not affect the overall sentiment of the market. Markets continued to do well. So I think the maturity of the broad market in terms of discerning what is the right valuations to invest in the various IPOs, and poor listing of a marquee IPO didn't affect the sentiment of the market. That's a bigger trend that I would be, I'm very enthused about.
Trade for 2022. When I say macro trade, I'm just breaking it down for a benefit of our viewers. If inflation comes back, buy hard assets like real estate. If rupee goes down, buy IT pharma. What is that macro trend or trade for next year?
Nikunj, I always believe that you cannot construct a portfolio trying to zero in on these macro trends, because at any point of time there will be 2, 3, 4 macro trends which will be at cross with each other. sometimes interest rates hardening, sometimes currency weakening, strengthening, sometimes geopolitical issues. And so I don't know how much can you keep on churning your portfolio based on the trend for the day, and maybe that trend changes after 2, 3, 4 months. I think investors should continue to just build up a portfolio which is kind of balanced, which will take care of maybe currency movements, maybe rupee strengthening, maybe interest rates, etc., maybe exports, local business. A balanced portfolio should do very well. I think whether it's interest rates hardening or global liquidity tightening, those are kind of given, everybody is aware of it. Maybe our markets have reacted once, maybe they will react a few times. But to be able to churn your portfolio based on these kind of trends is very, very difficult.
Okay, with that, Krishna Kumar Karwa, it's always a pleasure talking to you. Thank you so much for joining us live today on The Market.